Hello and welcome to another video from yours truly, Herb Katana, coming to you, one of the co-founders of My Virtual Bookkeeper. Today we've got a video. We are going to answer the question, how many bank accounts should my business have? Well, you may have a lot of bank accounts, and there's probably a good reason to have, multiple accounts. The number that I always look for is at least three. You want at least three bank accounts. You may have more than that, and that's totally fine. But why three? Why at least three? Well, I'll tell you. The first one you want is you want to have your operating account, right? This is going to be the account that all of your bills, all of your operating expenses are being paid out of. And then the second account that you want is your depository account. What's the account that all of your revenue, everything that your business collects, what is the account that that money goes into? And then the third account that you're going to have is your reserve account, right? So this is the account that you touch when your business is profitable and you're putting money into reserves, right? We could talk about how many months of reserves do we want on a later video, but for now we're just talking about what accounts should we have. All right, so if you have those three accounts, well, you can kind of tell based on the way I described it that your first account, your operating account, you're really only paying bills from this account, right? So you should never be depositing anything into this account. This is just where you pay your bills from, right? And so a best practice is when you set your monthly budget, which you could do if you had a bookkeeper, right? When you set your monthly budget, you are starting every month with that budget already deposited, or not deposited, but transferred into that operating cash account, right? And then throughout the month, when as you're collecting revenue, you are receiving that into your depository account, right? And so you're not you're not writing any checks, you're not paying any bills from your depository account. You are only receiving money into that account. And then as needed, you're transferring that money from your depository account into your operating account or into your reserves account at the end of the month when you look at your profit and realize how much you can set aside for your reserves. All right, so why do we do this? Why would we have this kind of method for running our business? Well, it's actually pretty simple. The biggest thing that we're doing here is we're adding a layer of complexity to how the business spends money. In order for us to spend money, well, we got to make sure that we have it in our operating account first, right? Well, the only way that that operating account is funded is by making a transfer from the depository account, which means there's an added layer of accountability there. If there's somebody on your team whose job it is to pay the bills or to spend money, then they're going to need to have that additional conversation with the person who controls the actual bank account, right? Which means if there's a transfer that needs to be made, they have to have that conversation and explain why they need the money transferred in the first place. And remember, if we started the month with our budgeted expenses already transferred into that account, we shouldn't need to make any additional transfers throughout the month. That money should already be there. And so if there is something or if there is a reason that we need to make a transfer, that conversation is happening between the owner of the business, which would be you, right? And the person who needs to go ahead and transfer that money. So that's one of the main reasons why we would do that. Some of the additional benefits that you have in doing this is it creates some clarity with you around how much exactly you have in reserves, how much money is spoken for. When you're looking at your operating account and you know that that's how much your business needs in a month to run, to operate, then you know that money's actually already spoken for. So you're not looking at your cash account and assuming that you actually have more money to spend or that you have more money to do things with. You know exactly that your operating account is already spoken for. Your depository account is just the money that you've collected this month. And so that's presumably going to be used to transfer money into the next month for your operating expenses. So you're looking at your cash differently, and you know that whatever is in your reserves, that's the money that you actually have made. That's the money that you've actually set aside as reserves, hence the name of the account. So there it is, folks. The three cash accounts that you need at a minimum, right? You may have more. I'm okay with that. But make sure that you're running your business with at least those three and in that method as well. So if you have any questions, of course, feel free to comment on this video. If you liked the video or if you have a different number, then we'd like to hear your comments as well. So let us know what you think. How many cash accounts does your business have as you're operating? And we'll see you all in the next one.